For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
Hello everybody, welcome to this webinar brought to you by Bursa Malaysia and managed by Life Champs. My name is Shen Chu. I'm the moderator for this webinar, and I want to welcome everyone to this session. So if you are, if you can hear us, see our screen, hear my voice, please type, please tell us like, where are you tuning in from? Are you tuning in from KL, PJ? Penang, Johor, Sabah, Sarawak, let us know where you are from, so we have a good idea of our crowd today. Yeah, good evening, everybody. Yeah, sound all clear. Okay, we have our friends all over from Malaysia, including friends from Singapore. Wow. I think some time ago, we also have guests tuning in from Australia as well. Okay, thank you everybody for joining this session. I know that you take time out of your busy schedule, especially on Friday evening, to be with us, so that we will make sure that we will make it well worth your time for this session. Now, when it comes to wealth building, right, the safest and the most sustainable way is through buying, investing into investment grade stocks instead of speculating your money on those penny stocks. So today, our topic is to share how we can use fundamental analysis to do sustainable long-term investing. Today's title is Sustainable Long-Term Investing with Fundamental Analysis. Our speaker here has prepared a lot of content to share with you today. I'm sure that this is going to be a mind-blown session, okay? So remember to stay tuned until the end. Now, before we begin, just want to go through a disclaimer. Whatever we share on this webinar is only for educational purpose. Whatever case studies that we present is only for educational purpose. In no way that we give any recommendation to buy or sell any companies in this webinar. So if you decide to make any investment decision out of this webinar, you do it at your own risk, okay? Now, allow me to introduce our honorable speaker today. I have known David for many, many years, and David also taught me. He's also one of my earlier teachers to teach me value investing. So I'm very glad that I managed to invite him back for a session with Bursa Malaysia. So David is an engineer by training. So he began his career as an engineer in the telecommunication industry for 10 years before turning to his passion in value investing. He served as a director in a local equities education and research firm for 3 years, managing research efforts and delivering advanced value investing and portfolio management education series. Thereafter, he stepped out to pursue his own aspirations, establishing the Spiral Thinker Group, a collaborative alliance to promote intelligent value investing and develop algorithm-based adaptive portfolio strategies for sustainable long-term wealth creation. So if you're looking for sustainable long-term wealth creations, David is a guy that you need to turn to, okay? Now, David is now a full-time investor and dedicates his time and resources to nurture the youth in financial literacy. He is often invited to speak in brokers' seminars, webinars, as well as other Bursa-endorsed events. And his professional comments and opinions on value investing are featured in business publications like Focus Malaysia. David also provides consultation services in value investing and advanced portfolio strategies for high net worth individuals. So today we are very lucky to have David in the house with us today. So David, are you ready?
Hi, Shane. Yes, ready to rock and roll.
All right, cool. So over to you.
All right, thanks a lot. So let me just share my slides. While I do that, thanks a lot for that very colorful sharing, introduction of my profile. Shane. But basically, if you strip off all the bombastic words, right? Basically, I'm just a very simple investor, right? And me and my friends, we do invest for the long term. When we say long term, right, we are talking about 3-5 years and above. And that is why I think this is a great platform for us to talk about how we do it, how we invest for the sustainable and the long term, yeah. But before that, I would like to thank LifeChamp as well as Bursa Malaysia for inviting me to come back again. I think this is like the 3rd or 4th year that I'm speaking on the platform, so thanks a lot, yeah. Now, before I continue, I just a little bit update of what the Spiral Thinker Group is up to. So, the Spiral Thinker Group has 4 business units. So the Gamma is the education unit. Previously, we were focusing on the English deliveries under the IVICC flagship. It stands for Intelligent Value Investing Community Connect. Starting 2021, and thanks to the pandemic, so we're going fully online for now. We also venture into our Mandarin speaking education series under this Intelligence Investing 投资. All right. So if you guys would like to know what we do, you do check out our Facebook. All right, the link is just in front of you there, yeah? So without much further ado, today is going to be a very basic topic, basic but essential. It's called Sustainable Long-Term Investing with Fundamental Analysis. Now, this is our very first topic under the ICM, Islamic Capital Markets series. And this is my very first time streaming from my home. Usually I do it in Shane's office, so hopefully everything will be smooth. Along the way, if you find that there are some technical difficulties, do ping Shane. Do ping Shane. He will inform me. All right. So without much further ado, today there'll be a couple of topics I would like to cover. Yeah. First of all, I want to kick off the topic by explaining or discussing what are the different approaches to investing, especially sustainable investing. Then we're going to move on to talk a little bit about business cycles and how it leads to stock market volatility. Then we're going to zoom down in detail on how myself and my group, Spiral Thinker, approach fundamental analysis by using the quantitative as well as the qualitative analysis. All right. Then I'm going to touch a little bit about how we do top-down to bottom-up screening. Then we're going to go for a case study towards the end. So make sure that you stay until the end. I promise you it's going to be a pretty interesting topic tonight. Yeah. So before we talk about anything, right? First of all, let's dissect the word investing. Okay. Now, a lot of us think that we are investing when when we are actually not investing. So, right now, don't worry. I'm not pinpointing anyone. I myself has actually gone through this phase as well. So it is very important before you actually step into the market. All right. What are the differences between investing and the other one, which is speculating? Now, don't get me wrong. There's nothing wrong. There's nothing wrong to be speculator in the market, but you have to know absolutely what you are doing. Okay, so I'm going to share with you guys some of the vanilla textbook definitions of what constitutes investing and what is speculating. Yeah, so I'm going to borrow the words from Mr. Benjamin Graham. Sadly, he has passed on, but he is considered the father of this value investing. In 1934, he he actually published a book called Security Analysis. And there's one very interesting sentence. He described that investing is an investment operation, one in which upon thorough analysis, so you've got to know deep down what you are doing, it gives promises a safety of principle, which means you must be have some sort of capital protection and a satisfactory return. All right, this is what you need to do to call yourself an investor. All right, so you've got to do your homework. You've got to make sure that whatever you're investing has a margin of safety. And last but not least, it must give you some sort of return that is enough for you to cover whatever that you want to. All right. Now, on the other hand, speculating are those operations that do not meet any of the things that mentioned here. All right. So any operations that do not meet these requirements are deemed to be speculative. Now, think about the last stock that you bought recently. Could be today, it could be yesterday. Did you go through a thorough analysis of what you're buying, the company, what it does, what products it sells, and which market they serve? Did you go through the process of seeing whether there's enough margin of safety in case the share price drops? And did you also go through the study of potentially is the investment or is this operation what are the potential return on the long term? Now, if you have not done any of these, then highly likely that you are doing some sort of speculation process. Now, don't get me wrong, it is okay to speculate once in a while, but just make sure that you know that you are speculating. Don't start being a speculator, then become a long-term investor, yeah? Now, actually, I would like to introduce another version of definition of what is investing by our beloved Mr. Warren Buffett, all right? He says that the investing is actually a transfer of purchasing power now with the expectation of receiving more purchasing power in the future. So break down into English, what it means is investing is a process where you sacrifice some capital today in order to have a higher purchasing power on the same capital in the future. So basically what he means is investing is a process where you just want to overcome inflation. Yeah, that is a very basic thing that you have to overcome first and foremost. Then later on, of course, if you make a lot of money, that's considered bonus. Yeah. All right. So basically these are the some of the textbook definitions of the differences between investor and a speculator. Know the difference and know what you are doing. Okay. Now, so tonight's topic is about investing. So let's put speculating aside. Now, in investing, generally, acceptable, the general accepted two school of thoughts, whether you are on the fundamental camp or you are on the technical camp. All right. So this is what we call fundamental analysis as well as technical analysis, FA or TA in short. Now, what is fundamental analysis? Fundamental analysis of FA evaluates securities, which are your stocks, to gauge or to estimate the intrinsic value of the asset or the companies that you invest in, all right, by looking at macroeconomic factors such as how the economy is doing, or what are the sector or the industry conditions that the company is serving, as well as drilling down to the microeconomic factors, including the financial strength of the business or the stock, and the company's management, and the financial ratios, the products that they sell, so on and so forth. Yeah. So that's basically fundamental analysis. In short, you look at the business, you look at the stock, you look at the underlying asset that you're buying by looking at the macro as well as microeconomic factor. On the other hand, technical analysis or TA is actually more of a trading discipline, all right, which is used to mainly evaluate as well as identify opportunities by looking at the trends as well as patterns of the price movements. So this will include things like how the share price is moving and the volume profile. Okay, and these two, price as well as volume, can be further constructed into many other indicators that form the world of technical analysis. All right, but for tonight, our focus will be on the fundamental analysis side, FA, and how we can use this to build a long-term and sustainable investment portfolio for your own. All right. Okay. So just now I introduced this gentleman, Mr. Benjamin Graham. So another thing that he mentioned, which I think is very important, essential for me to mention, is that he believes that investing is most intelligent when it is most business-like. Now, what does that mean? It means that don't try not to think of the stock market or the stock as an end in itself. In fact, the stock is just a vehicle to represent a business. All right, investors should consider, the ownership of the business that the stock represents. So I know a lot of us, when we think about stock market, basically we just talk, some of us even just invest in the stock code, right? Like 6947 or 3535, for example. Some of us don't even know the name or the business, what they do behind, that represents the stock. But that of course will be considered mostly speculating. If you want to invest as well as to achieve sustainable results, investors should aim to own good and lasting businesses. Later on, I'll share a little bit about what makes a good and lasting business, right? Ideally, of course, you should buy at a fair price or an undervalued price that makes business sense. And then eventually, if you hold the business for a long term, eventually this investment should give you a sustainable as well as predictable annual compounding return. Okay. Now, in other words, investing is really about owning a piece of the business. All right. Now, if you take it by extension, investing is also a process where you partake into the economic growth of a country or a market or a industry. For example, if you like technology and you believe that technology is going to grow in the future, it's going to become more important, then you partake into this growth by investing in good businesses that are either in the supply chain or they are the original brand owners of the technology space. Okay, so that's about a very important message or a very important mindset that investing is really about owning the business. I'll talk about mindset, right? So I would like to set some expectation for tonight's webinar. You can get a lot of educational resources, including videos, including blog entries, including articles or books, right? On, like how to read financial statements or how to construct a business by looking at the financial statements or the financial ratios when it comes to fundamental analysis. Now, I would like to reiterate that this is not what we are trying to do tonight. Now, tonight, my purpose in delivering this webinar is to give you the mindset, the right mindset to be an investor, to a sustainable long-term investor. Okay, so hopefully through my sharing, I will give you a framework, a mental framework of how you should approach the market or how you should approach the stock market if you like to do sustainable long-term investing. Okay, so this webinar is not about PE ratio, it's not about dividend yield, it's not about all these financial numbers. It's really about mindset change. Okay, so with that aside, now, when we talk about, just now we say that, investing is really owning a business, right? Then we have to look deeper into business cycles. You know that, not every day is Sunday, right? Business will go through up and downs, which is, part and parcel of running a business. If you think running a business is simple, right? You should try, or you should try asking your friends who run businesses. Actually, volatilities or up and downs are, it's a very normal thing in the business life. Yeah. So generally in the business cycle, there are four phases, which actually forms the peak as well as the trough, right? There will be always a recession. All right. I think last year, 2020, due to the pandemic, everyone was so afraid, that we are actually hitting the recession already. Now, the recession as it goes on, right, it actually lead to depression when the economy is depressed. Now, of course, we know that things will not last forever. Now, with all the efforts that is going on to pump out the economy or pump out the market, like these are stimulus from central banks or the fiscal programs by the central governments, right? It should slowly lead to the recovery phase. And then, if the recovery is successful, then we will continue the economic expansion and the cycle will continue. All right. So this is a typical business cycle. It affects any sort of industries. not just commodities or airlines. It affects every single businesses out there. All right. Now, of course, by a lot of times, if we extend this understanding, in fact, because businesses make up the economy, right? So when we look at the GDP of a nation or the global GDP, right, actually it goes through the same cycles. Now, then you have to ask yourself, last year was a wake up year, with this pandemic. Basically, it opened our eyes a lot. So where do you think we are now? Are we still in recession, or have we avoided a recession that led to depression, or are we really on the recovery phase? So you got to ask yourself this. All right, look at what is happening around you, especially when you're a business owner. I think you are more sensitive to this. All right, so then you can actually gauge where we are now. Now, the stock market is entirely a different animal. The stock market does not represent the economy or the business, but it is an indicator, right? It's like a proxy, all right, but it does not represent the health of the economy, right? Okay, so now as I mentioned just now, business go through two cycles, which is the recession as well as the recovery, the peak and the trough, right? So we've got to look deeper into these two ends, right? So we can start talking about recession, because it was for a lot of us, it is still very fresh in our mind. Now, what forms a recession, or what we call a vicious cycle? Now, let's imagine now I think it's April, right? I think just last year, April was a very tough time that we had to go through. I think all of us were locked down under the MCO, not just Malaysia, all around the world. So when that happened, right, basically there is no employment. Of course, for a lot of us who are lucky, we can still work from home. But for a lot of people, especially the gig workers, or the gig workforce, the temporary workforce, those who work in restaurants, or most of the business out there, right? They find that their income has stopped, zero. All right. Now, so when incomes fall, or when your income is affected, what do? Do you consume more? Do you consume like normal, or you consume less? You try to preserve whatever you have, right? By adjusting how your way of life, by adjusting how you consume, how you buy things, right? Now, when consumption in a whole, imagine when more and more people does that, and it will affect the entire consumption industry, right? Then, because people consume less, business will produce less as well. Productivity will fall. When productivity falls, business had to protect their bottom line. They had to protect the sustainability of the business. They will also not employ more people. And this cycle will continue. That's why it's called a vicious cycle. All right. Then slowly, the recession would lead to a depression. But as you know, when this happens, right, humans, we are a surviving species. So of course, governments around the world, they will not sit back, and let this happen without, trying to fix things. So that's why you hear about, governments or central banks pumping money into the economy to stimulate, like in Malaysia, we have all this bantuan, like the ICNA, right? And I'm sure a lot of business has actually benefited a lot from that. So with these stimulus programs, right, which is including the financial stimulus from central banks, as well as the fiscal stimulus from governments, right, by trying to like jumpstart the economy again, right? So slowly, employment should rise again. Why? Because the consumption should slowly come back as well. When consumption comes back, all right, of course, business will have to produce more. When businesses need to produce more, they'll need to hire more people. And then when more people are hired, they have jobs, right, income will rise. Then slowly it will help the economy again to jumpstart. Then that's why this is called the virtuous cycle. Now, but I would like to again maybe highlight something here. In any crisis, or even last year, right, when the whole world basically just froze, most businesses were affected, but there are also some businesses that actually did very well, in the face of this crisis. Now, for example, let's not talk about the stock market for a moment. Let's just look around us. Last year, right, 2020, when a lot of these businesses were shuttered down, right? In fact, I mean, in my own observation, the groceries were doing very well. You know, the grocers like, you know, your Jaya grocers, your village grocers, your Aeons and whatnot, right? They're doing very well. In fact, they're expanding even up to today. So that's one of the business that does well. Now, if you look at the on the higher value chains, right? Technology companies are doing very well. Why? Because when more people have to work from home, they'll need to rely more on electronic devices like computers, like, you know, your electronic devices, your iPads, right? In fact, kids, you know, children are going through their online classes, so they need either a tablet or an iPad. So of course, the demand for those products will increase tremendously, and because of that increase in demand, they will have to produce more, right? So in any crisis, right? There are bound to be pockets of opportunities where, you know, where we can invest our hard-earned capital to, you know, to grow. Yeah. So don't worry too much about crisis. You know, and a lot of people say, "Oh, crisis is coming. The stock market is going to crash. Economy is going to crash." Well, it's going to happen anyway. So let's just you know, take a step back and really look at things and see where are the opportunities are. Trust me. All right. Mark my words, in any crisis, there are bound to be opportunities. Okay, so basically this is just a very simple introduction of you know, this recession as well as recovery. Now, right now, a lot of people are banking that, you know, after the shutdown last year due to the COVID-19 pandemic, right, as well as the, you know, lockdowns around the world, actually economies are slowly recovering. Now, I know a lot of investors as well as economists are banking on this. Now, I myself, as well as my team, we are also looking forward to the recovery of, you know, jobs and economies around the world. But whether the recovery is real or, you know, substantial is yet to be known, because there's still a lot of uncertainty. What we are facing now, or what we're going through now, is a lot of pent-up demand. You know, because last year, right, when everyone was staying at home, right, people just can't go out, right? People cannot consume, people cannot go out and you know, be productive. So what is happening now, as the economies or the countries are slowly relaxing their, you know, this lockdown or these SOPs, right? So slowly we see a lot of consumption coming back. But bear in mind, if there's another third or fourth wave coming out, which is more infectious, right? Maybe the recovery may be set back, you know, so just be mindful of that. Okay, so now, just now we talk about how different cycles will affect businesses, right? And we know for a fact that actually the stock market does not represent the economy or is a direct correlation of the business or the economy. But what the stock market is actually it's like a crystal ball. Normally, before what happens in the economy, the stock market will be reflected in the stock market first. That is why the business cycles will lead to these up and downs in the stock market as well. Now, let me just give you an example. When it was announced that the MCO may be lifted, right? What are the companies or what are the stocks that suddenly just jump out in price? All right, I can give you a few. Airlines stock will jump out already. The entertainment like Genting will jump out already, even before, you know, the recovery is really set in. Now, because stock market is all about expectations as well as emotions, all right? It does not necessarily represent what the business really does or deliver, all right? It's, in the short term, the stock market is like a voting machine. So when everyone feels positive, the stock market will go up. When there's a lot of fear, the stock market will go down in a very fast way as well. Okay. Now, so it is very normal for stock market to be volatile, especially in uncertain times like this. And you know, and these cycles will go on. You know, it wouldn't stop. It wouldn't stop just because the pandemic is over. In fact, you know, since the GFC, the 2008 global financial crisis, we have seen a lot of more and more volatility. But the stock market keeps going up. Now, why is that? Why is that? Think about it. Now, although the stock market is very volatile, as you can see here, all right, but as long as the businesses grow over the long term, right, this volatility, all right, if you look at it in a high level, right, you should also see that the price will slowly go up as well. Yes, granted, they are still very volatile, as what you can see here, but as long as on the long term trajectory, it is growth. All right, the value of the business or the asset price should slowly go up as well. Okay, and this is the virtue of owning a sustainable business. You may be wondering, hey David, why is sustainability so important? It's because you want to own a business that will still be there, will still be around, when you retire or when your children goes to university, right? You don't want to invest in a business that is doing very well today, then suddenly in the next couple of years, boom, just like that. Okay, because we want to sleep well, when after we invest in a company. So that is why, if you really want to own a sustainable portfolio of investments, right, you should try to look for those business that will grow long term, no matter what. Look for those business that has sustained and survive and even thrive after each these crisis. And there are many companies like that out there, not just in other markets. In Malaysia as well, we have a handful of these companies. Okay, so later on, I will talk about one such company, Sharia compliant, that everybody knows. Okay, so let's continue. Now, it is important for us to understand the different business cycles that your business is going through, because we need to do this step called categorizing your stock. Now, before you build your invest, right, you need to understand what kind of stock or business that you are investing. Are you investing in a high growth stock, or are you investing in a highly cyclical business, or are you investing in those, stalwarts, like the business has been around for 30, 40, 50, 100 years, and it's very stable, but it's not growing in such a high high growth era, like our technology stocks like Facebook or Amazon, right? So you got to know this. Now, more importantly, you got to know also whether if the business that you're investing are actually risky, whether they are, turn around, or they are failing, or they are in a sunset industry. Now, think about it. So these are the 6 category stocks, which is being formulated by Peter Lynch. He's a very famous investor. So he basically categorized into 6 categories. Stalwarts are what we call investment grade stocks. Then there are also slow growers, fast growers, cyclical, asset plays, turnarounds. But other than these 6 categories, of course, these are not the only category of stocks. We have other categories like sunset, like startups as well. Now, you need to understand where the business that you invest in sits at, which category they sit at, because then only you know what kind of risk that you're exposed to. Now, generally speaking, in this very colorful chart, stalwarts, the slow growers, and the fast growers, they are relatively lower risk compared to those on the red colors, like turnarounds, cyclical, or even asset plays. Okay. Now, of course, the highest risk are those sunset as well as failing business. In fact, even startups are quite high risk as well, because startups do not have a track record for you to, formulate a sound description of the business. So startups may be successful, but most startups may not be successful as well. Okay. Now, let me give you some example of, very long-term sustainable business, right? Household names that we all know. For example, Coca-Cola, right? I mean, we grow up, drinking Coca-Cola when the weather is so hot like these days, right? Sometimes we just want to refresh ourselves with a very cold can of Coca-Cola. Disney, Disney is a household name that is in every children know, and when these children grow up, right, they will still remember Disney, and the children and their own children will also be consumers of Disney's products, whether it's movies or cartoons, or even going to their entertainment, Disneylands, right? And Amazon's, Microsoft, these are all the names that are big today. All right, and they have been in the business for many decades, and likely, all right, they should be continue, to do very well in the future. All right. So these are the kind of names that you want to, look at, if you want to invest in long-term sustainable business. Now, on the other hand, all right, there are also businesses that used to be very, household names are very strong previously. But today it's like they're nobody. I think I can name you a few. Kodak, I remember when I was growing up, right? Kodak is like the de facto brand, when it comes to photography, all right? You still remember the yellow, this film roll, negative roll, right? It's all Kodak, right? But what happened to Kodak suddenly? Okay, Kodak was suddenly phased out because of the digital camera. Now, did you know this fact that ironically, Kodak was one of the first companies that came out with a prototype of a digital camera, but because the management did not believe in the threat or the opportunities of a digital camera, right? They basically missed the whole run. All right. The same would go for Xerox. The same would go for Nokia. Last time when you own a Nokia, right, it's like a fashion statement, isn't it? All right. But where is Nokia today? Nokia is overtaken by Apple, by Samsung, right? All right. Yahoo as well. Yahoo was overtaken by Google, all right, and other, these internet giants. Now, if you look at these four companies that I just highlighted, right, what is the common ground? What led them to phase out from, to be forgotten? In fact, you ask a millennial or don't know what generation, very young people today, do you know Kodak? Do you know Nokia? Do you know Yahoo? Right? Most of them don't even know what this company, that these companies exist before. Now, one of the key things is actually most of these companies fail because they fail to innovate. They fail to innovate and position their business future or their business prospect, their outlook, right, by aligning themselves with the technology growth or the technology advancement or the change in consumer behavior. Okay, so this is one of the traps that a lot of businesses fall into, and if they cannot pull themselves out, right, eventually they'll still phase out, like what this company does. Okay, now I know what you're thinking. Hey, David, you're talking a lot only about these, stocks overseas, but how about companies in Malaysia? Okay, I hear you. So I'm going to shoot that question back at you. Now, AirAsia, AirAsia is still one of my favorite businesses in Malaysia. All right, I think they have done very well. Okay, but because of the pandemic, right, before 2020, right, none of us who has the same mentality, right, you ever think that one day all the aeroplanes will be grounded on the runway and never fly, right? But it did happen, and it's a wake-up call for us. So if you look at AirAsia, knowing AirAsia, just by your understanding, you don't even know how the stock is or what are the fundamentals, right? Just look at AirAsia. Which category would you peg AirAsia at today? Are they slow growers? Are they stalwarts? Are they cyclical? Or are they turnaround? Okay. Now, that is why it is very important for you to understand a business. I give you a couple of seconds to think about it. Okay. The Spiral Thinker actually covered AirAsia quite a fair bit, in-depth coverage of AirAsia a couple of years ago. We are still very much following the development, all right, but they are not one of our core investments right now. Okay. Now, whether AirAsia will come back again in the future, right? I think the chances are very likely because AirAsia is a very well-run airline. In fact, it is one of the most lucrative airlines in the world. Okay, but whether AirAsia, the business profitability can go back to the heydays, whereby they can net about more than 2 billion ringgit of cash flow in a year. That one is a big question mark because why? It depends, like I mentioned here, like I mentioned earlier on, it depends on how fast the recovery will come, especially for the travel industry. If it's going to be slow, then of course it will take time. But even when it does come back, right, with the added SOPs, and or whatnots, right, it will increase costs, right? So whether AirAsia can go back to that kind of profitability before, all right, is still very much unknown to us. But what we like about AirAsia, what I like about AirAsia is that, they're not just sitting there like a lame duck to say, oh, okay, we are hit by the pandemic, boo-hoo, or try our best to turn the company around. In fact, the management is very innovative. So they know that the planes cannot fly. So what do? They try to innovate. What is AirAsia's biggest assets? It's actually not the planes. Tony Fernandez has sold all the planes to a joint venture company. All right. In fact, they don't own many planes now. So what is AirAsia's most valuable asset? Is actually the database of the passengers or the people that have flown AirAsia before. Now, of course, there are many ways for you to monetize this database, as well as the routes or the landing rights that they have. That is why Tony and the management team is trying to venture into other business like deliveries, or I think that they have a new logo now. So I know it sounds very unorthodox. A lot of people laugh at him and say, "Wow, how come AirAsia become a food delivery company now?" Well, at least they're trying to do something. And don't underestimate what they can do. They have actually grown to be the largest airline in the region. So probably give them time to see whether they can actually turn things around and venture into other businesses. Yeah. So right now, for myself, I will categorize AirAsia as a turnaround, as well as a cyclical and a potential asset play. Why? Because actually there are a lot of assets in AirAsia that has yet to be unlocked, has yet to be monetized. All right. Okay. By the way, just to be clear, this is not a stock pick. This is not a buy call. I'm not licensed to do that. Basically, just to highlight to you, why it is important for us to understand our business so that we can categorize the risk. Okay. So that's about it. Now, coming back to fundamental analysis, right? So FA, right? Now, in Spiral Thinker, what we do is under the world of FA. Now, there are many, many ways for you to do fundamental analysis. But for us, we simplify it to two subgroups, what we call the qualitative as well as the quantitative analysis. Okay. Now, what is this? What is this meaning, right? Qualitative analysis under the FA school of thought for us is a subjective method. So it's very subjective. To evaluate a business based on unquantifiable information. So unquantifiable data such as, management quality, what products they sell, what markets they serve, how is their clientele relationship, where is the industry cycle that they are going through right now, as well as the economy, the macro factors like the demographic changes or consumer behavior. All right, so these are the qualitative factors of a business that we actually focus a lot on, especially the management quality. Right, to us, management quality is one of the most fundamental as well as important factors for us to decide whether we want to invest in this business on the long-term basis. Now, on the other hand, under quantitative, as the name suggests, right, it is a more definitive. So the qualitative is a subjective method. Quantitative is a more definitive method to value a business based on quantifiable financial figures that we can get, that we can see, that we can calculate, like what, like profit, like cash flow, like dividends, like balance sheet strength, so on and so forth. And these are the things that we can calculate and form an opinion about the business. All right. Now, in our opinion, to be able to do proper fundamental analysis, you need to tackle these two angles, which is the quantitative as well as the qualitative. Now, I know a lot of people out there, a lot of investors out there, they focus a lot on quantitative data. Yeah, this is important, but you have to think about it. The company is the quantitative strength does not drive the business. It is actually the quality of the business that drive all these numbers. Why do I say that? Now, this is the Spiral Thinkers business view approach to fundamental analysis. Like I mentioned, qualitative as well as quantitative. Now, how we look at this is, we look at the top part first, which is, the qualities of the business, like, the business model, the management quality, and the market strength, right? Now, these are the qualities that will drive the bottom part of the business, the value. It will create value, and we can access value through performance, through the strength of the balance sheet, as well as the efficiency of how they turn the profits into cash flow. Okay, now don't worry, I'm going to spend a little bit more time to talk about this. Again, this is the Spiral Thinker Group financial analysis model using the business view approach. Yeah. Now, as I mentioned, there are two parts, the top part and the bottom part, and we focus more on the top part first, which is the quality, right? Now, for the quality pie, we actually separated, or we categorized the three entities, which is the business model, which means when we invest, when we look at the business, right, we look at the business model, how profitable it is, or are they operating in the Red Sea? Are they operating in the blue ocean or the red ocean? How adaptable is the business against, these vicious cycles of the economy, of the business cycles? And most importantly, how sustainable is this business? If you think about my examples just now, like Kodak against things like Coca-Cola, all right? How sustainable is this business in the next 5, 10, or even 20 years? Okay. Now, other than that, we look at how strong if this business in the market that they serve, what kind of value proposition, that they have that differentiate them against their competitors or their peers, what competitive advantage that they have, whether they have more, for example, do they have access to cheaper raw materials? Do they have access to better talent pool? Do they operate in a business environment that is more friendly for businesses like them? For example, tax incentive given to certain businesses in some countries, and most importantly, what kind of growth prospects that you're looking at? So these are very important market markers, like we call it, right? But among these three, actually, the most important is the management caliber, because any business will go through cycles with up and downs, right? And what determines whether a business will be sustainable, right, is really about the management. A good management has to be a visionary management, meaning they have to be forward-looking, right? They have to be a few steps ahead of their competitors so that they do not fall back in a competition. They must have good integrity, meaning they don't cheat the investors. And most importantly, they must have a proper succession plan. Now, especially in countries like Malaysia, right, there are a lot of very well-run family business. Don't get me wrong. They have become very successful businesses, even conglomerates. But if they do not take care of their succession planning properly, right, I think probably somewhere down the road, the business may start to falter. All right, that's why it is very important to look at the succession angle as well. Okay, so these are what makes the quality of the business model, how strong they are in the market in terms of market penetration, as well as the growth prospects, and most importantly, management integrity or the management caliber. Now, when these are done right, generally these three things are done right, naturally the result will flow into the numbers. And these numbers will form, how we how we evaluate the business, how we come up with some sort of valuation for the business. Okay. Now, very briefly, we use these financial statements, the three financial statements that you should know, which is the profit and loss, or called the income statement, the balance sheet, as well as the cash flow. Now, how do we look at this from an investor's point of view? The income statement will represent the performance of the business. Now, normally when people say, "Oh, this business is performing," it actually means that they're performing either on the top line or the bottom line. Now, what does this mean? It means that the sales are growing, the profits are growing, and they pay more dividends. They are more profitable. All right, so on and so forth. These are what constitute, the performance of the business, and we can gauge this through the profit and loss income statement. Okay. Now, on the other hand, the balance sheet is also a very important financial statement. It basically gauges or tells you how strong, what the financial strength of the business, right? And we can look at this through how much cash or assets that they hold against the liabilities. Okay. Now, these are what general people does, but in our team, in Spiral Thinker, we look deeper into the balance sheet by looking especially at how they manage the working capital. The working capital means how they manage their cash on hand, how they manage the inventory, how they manage their suppliers, as well as the customers through receivables and payables. These are all the flags that we check to estimate or to gauge how strong is the financial position of the business. Now, how strong it is, right, will determine whether a business will survive through any hardships. Like, for example, last year, during the pandemic, when a lot of these businesses were shuttered, right, only those businesses that has a very strong balance sheet will survive. Those businesses that have a weaker or even very poor financial position, right? They will be in need of, financial aid, like, borrowings from the bank or stimulus checks from the governments, all right? Now, imagine if that did not happen, a lot of these businesses will actually fail. In fact, a lot of businesses around us have failed, sadly, especially the SMEs, right? We do hear a lot of businesses which has been, growing or present for many years, even hundreds of years, suddenly shut down just because of one tiny virus, right? Especially in the retail space, and that's pretty sad. But again, coming back to here, actually, that's why this financial position strength is very important to make sure that this business is sustainable in the long run. Okay, and last but not least, the cash flow statement is actually a way for us to gauge the efficiency of the business to convert the profits, all right, into real cash. Now, the profits that generate in the income statement may not necessarily be 100% cash. How we look at what is the real cash generation from the business is actually we look at the cash flow statement, especially the operating cash flow. All right. Now, other than operating cash flow, we also look at how much money that the company spend in order to grow the business. That's what we call CAPEX, capital expenditure. That's under investing cash flow. We also look at how much financing the business needs, to sustain the operation, the daily operations through the financing cash flow. All right. So tonight I'm not going to go through in very detail. You can actually, there are many resources out there, many YouTubes, many books, many online resources that you can actually refer to understand more about this. So basically, I'm just giving you a top-down view of how we look at on this fundamental analysis through the qualitative angle as well as the quantitative angle. Okay, so I hope that that is clear. Now, my last topic before I go to case study will be how we look at how we actually screen or how we filter businesses to invest in through this top-down and bottom-up approach. Okay. Generally, before we look at or before we decide or before we even consider what kind of business to invest in for the long term, we normally look at the top-down view first, meaning we identify what are the industries or the major trends that is happening right now that is good to grow at least for the next 3, 5, or even 10 years. What is the macroeconomic picture now? Which sectors will be growing regardless of all these uncertainties, as well as some other factors like geopolitical tensions, so on and so forth. Then when we identify a particular sector or particular segment of the market that we feel has a potential story or potential growth in the next couple of years, right? Then we look deeper into that sector or that industry, and we'll try to identify who are the market leaders of this industry. For example, last year, right, during the pandemic, one of the business that really thrived in Malaysia was actually glove makers. Now, I'm sure a lot of you who are present with us tonight, I'm sure you have bought glove stocks before. Now, I hope that you bought last year and not recently, because if you bought recently, then you have bought it on the high side. Now, so we identified actually glove stock was one of the thriving businesses despite the pandemic last year. So when we look deeper into the industry, right, by looking at things like management quality, the business model, how they what kind of markets that they serve, what kind of products, the main products that they sell, and then compare it and then couple it with the financial strength. Historically, are they performing in terms of the profitability? How strong is the cash management, as well as whether they are highly geared, as well as how strong they are, how efficient they are in generating cash flow. Then we look at what are the companies in this space to invest in. So for us, we were actually quite focused, concentrated on a couple of glove stocks, including Top Glove as well as Supermax that time. Okay, but up to today, we have actually made quite a good profit from these two stocks, and I have to say that right now we have no more glove stocks. In fact, but that does not mean that on the long term it is a failing business. In fact, we feel that the glove is a long-term business. It's just that it's going through a down cycle right now. Okay, so basically this is how we look at top-down and bottom-up approach. We look at the big picture first before we drill down into the details to decide what are the companies that we would like to invest in. Okay, the top-down and bottom-up approach. Okay, now with the boring theory aside, now let's go for a case study. All right, now I promised Shane that I'm going to do a very simple case study that everyone know about this company. In fact, I can guarantee that all of you listening in are consumers of this product. And as a shareholder, I would first like to say thank you very much for your support for my business. Okay, so disclaimer, I myself, as well as my friends, own quite a few Nestle. This company is called Nestle. I think you guys should know already. I have a portfolio for my children for when they grow up. My fourth daughter, my fourth child is 6 years old. So me and my wife, we have a portfolio, for our children. And I can say that about 1/3 of our portfolio has investment in Nestle, and this is for the long term. All right. Now, why do I like Nestle a lot? So let's look at this business from what we have gone through tonight. Top down. Let's go through the top down and then bottom up approach. Now, top down, right? The quality of the business, right? Why is this company? Now, do you know that Nestle is the largest food company in the world, not just Malaysia, right? Now, and in fact, in Malaysia, they have been operating for more than 100 years, 2 generations. All right. In fact, they landed in Malaysia way back in 1912, when they started out as a condensed milk company in Penang, and it grew to what it is today. Okay, and today, I think most of us would know Nestle through the 3 major products, which are the Milo, and the derivatives as well. Nescafe, and in fact, I drink Nescafe every day. I just forgot to ask my wife to bring the Nescafe bottle to show you. And in fact, we also consume a lot of Maggi products. Now, when I say Maggi, it doesn't just mean the instant noodle. Actually, the Maggi is a whole range of these culinary preparation products, like the chicken stock, or the chili, the sauces, and to the flours or whatnot, right? So these are the products that we consume every single day, regardless whether it is pandemic out there. In fact, during the lockdown, I think most of us consume more Nestle products. So I really like to thank you for your support. Okay, so this is what Nestle does. All right, they've been here for more than 100 years. They're the largest food company in the world. And you ask yourself, will Nestle still be around in the next 5, 10, even 20 years? All right, because you have to know that, how sustainable is the business if I want to invest it in the long term. All right, so this is the qualitative part. Of course, there are more factors which we have to consider, but for now, I just simply introduce this some of the key information to you. Right, now let's move on to dig a little bit deeper about Nestle. Now, on the quantitative side, remember just now I talked about qualitative. All right, now it's the quantitative. Now, do you know that Nestle has been very profitable since they got listed in Malaysia? Now, of course, I do not have I think they were listed in Malaysia in, can't remember, before 2000s or even before that. They are listed for more than, I think, 30 years in Malaysia already, more than 20 years, definitely, right? So I do not have all the data, but what I gather from our database is that we have a 17-year data. So in this 17 years, between 2003 and last year, in the 17-year space, the revenue have grown by 87%, or if you translate to a per annum, which is about 3.7 per annum. 3.7% per annum. Then you may be thinking, hey, David, 3.7% per annum is not that impressive, right? Because I know businesses that grow 100% every year. Yes, that's true. But don't forget, just now I talked about you need to categorize a business. So Nestle is definitely not in a high growth business. In fact, you can categorize them as a slow growth or a stalwart or investment grade company. So normally these companies do not enjoy very fast, very high growth. But despite that, in spite of that, their net profit has grown almost double of what their revenue is growing in the past 17 years. Their sales grew about 87%, but their net profit grew about 151%. And most impressively, look at the dividends growth. The dividend has grown 2.7 times, almost 3 times in the past 17 years. What does this mean? 17 years ago, if you invest in Nestle, right? let's say they give you 1 ringgit per share of dividends. Today, they'll easily give you 2 ringgit 70 cents. That's what it means. So translated on a year-on-year basis, they are compounding 8% per annum for the dividends, and that is very impressive. Okay, so these are some of the key numbers that we look at for the quantitative analysis of this business. How about the quality, right? And we know that actually Nestle is a very well-run business. That's why they can be around for more than 100 years in Malaysia. In fact, they have this rotational board of directors, rotational exercise where every, I think, 3 or 4 years, they would change the CEOs or change the captain, so that no one will be the CEO for too long, in order to drive sustainability as well. Okay, and as far as I have been invested in Nestle, I know that actually the business actually operates on 3 pillars of principles. One is they will always invest capital expenditure for future growth. They will always distribute dividends to shareholders to enhance the shareholders' value. And last but not least, they always invest in innovations and research in order for them to remain competitive, to remain relevant in the consumer space. Okay, and to be more specific, what are the growth catalysts? Remember, I talked about this quality of aspects of the business when we invest for the long term, right? Now, if you think about it, Nestle, by the nature of the business, right, should grow in tandem with the population, isn't it? Right? The more people we have in the country, then likely there will be more people consuming the products, isn't it? Right? In fact, inflation also helps the business. Why? Because when you have inflation in price, naturally they will have to pass on the price, the cost back to the consumers. Now you may be thinking, hey David, the Maggi mee that I used to take, they're still the same price as almost 5 or 6, 7 years ago. Yes, that's true. But did you notice that actually sometimes the packet is smaller than last time? Or in fact, management has done a very good job in managing the cost of producing products like Maggi mee to you, so that the consumer will not be burdened by the increase in price. So that's what they do. Okay, and consistently, Nestle has been introducing new products into the market through their R&R, the innovations and research efforts. And they have a lot of internal policies as well as culture, that make sure that they have a sustainable business. Now, why I am very excited about this business, especially recently, is because, last year in 2020, Nestle spent about 280 million, as you can see here, 280 million in terms of capex to grow the business. And as you can see in the profile, 280 million is the highest capex between 2015 to 2020. Now, why do you think they want to spend so much money, right? Is to grow the business, to grow the top line. Remember, the top line grew about 87% in the past 17 years, and I'm sure that the top line will continue to grow in the next 3, 5, 10 years. And how they do that? They try to do that by investing into the business to grow, new products, to go into new markets. Now, what I'm so excited about recently is because Nestle just announced that they are venturing into plant-based meal, and these days it's very getting more and more traction, right? People are going for healthier choices of food, and also because protein is going to be more expensive going forward, so people are going for alternatives like plant-based meat. And Nestle has the first plant in Southeast Asia in Shah Alam. Now, I don't know about you, but I'm very proud to be a Malaysian as well as Nestle shareholder. All right. And other than that, they're also going for premiumization of their products. Like, last time, we only know about Nescafe, right? But these days we've got Nescafe Gold. In fact, Nestle is starting to market some of these Starbucks roast coffee beans as well on the shelves, right? So these are the things that the company is trying to do to grow the business for the shareholders. Now think about it. Is this the kind of business that you want to invest in, all right, on the long-term and sustainable basis? Okay, these are the kind of things that you should look at, and how do you know this? How do I know this about Nestle? It's through market research. When I talk about market research, means you go to the market, you go to the shops and see how the product is doing. You attend the AGMs, you have to listen to the management, what they have to say. You read the annual reports, you read the financial reports. And these are the things that you need to know or to do in order for you to follow through what the business is doing, how the business is doing. Yeah. Okay, now, so I'm going to spend a couple of minutes here. I think I slightly overrun time a little bit to look at the quantitative part of the business. Now, I know out there you be exposed to a lot of ways to look at the fundamentals of the fundamental analysis, like, look at the profit and loss, the cash flow, dividends, right? But here I would like to show you a unique way of how we look at the quantitative fundamental analysis. Okay, now, so granted, you can look at the sales, the revenue is growing in 2004, the total sales of 2.9 billion in 2020, Nestle grew almost double to 5.4 billion. The profits grew from 220 million to 552 million. They pay out more than what they earn, so on and so forth, right? But what I would like to highlight here today is actually the cash conversion cycle. They will tell you how strong this business is. Now, what is cash conversion cycle? Now, don't worry, I have simplified it for you here. Now, before you produce something, right, first of all, you have to buy the raw materials, right? So Nestle, what are the raw materials that they buy? They buy milk, they buy flour, they buy sugar, they buy all this confectionery for them to produce the products, right? So when you buy the materials, it's actually becoming inventory. Okay. Now, of course, good businesses, when you buy, you don't pay cash straight away. Now, what you do is you pay later on, and that's what we call payables. You owe your suppliers a certain amount of money for a certain amount of time. Okay. Now, then during that time, what the business is supposed to do is, to turn the raw materials into products to sell into the market. Okay. Now imagine after a certain period of time, the goods are sold. Now, for the same reason, when you sell a product, when you sell a service, right, you may not necessarily get the cash straight up front. All right. You may only receive the cash later on in the future. So this is a timeline that we see. You purchase the raw material, not necessarily in cash. You may only pay it later on. All right. But between the payment made for the raw material until the payment is received for the goods that you sell is what we call the cash conversion cycle. Okay, now think about it. When you run your business, do you want a very long cash conversion cycle or a very short cash conversion cycle? Think like a businessman now. After all, you are a businessman when you invest in a business, right? When you invest in a stock. Now think about it. Do you want to receive your payments from your sales as soon as possible, or you want to drag it as long as possible? Okay, now in a sound business, what we like to do is try to prolong this period, the days that you had to pay for your services or the raw materials, and you want to shorten the days that you receive the money for the goods you sold. All right. In other words, we would like to shorten this cash conversion cycle as much as possible. Now look at Nestle's cash conversion cycle since 2004. In 2004, the average cash conversion cycle for that year was about 39 days. Now, what is the meaning of 39 days? 39 days is about 1.5 months. Then slowly, you can see along the way, they reduced to 35, then suddenly increased for whatever reason, then suddenly it reduced to 24, it reduced to half a month, 14 days. Suddenly, you see, hey, how come it is negative? Hey, David, something wrong with your data, lah. How can days be negative? All right. Yes, technically the days are negative, but what does it mean in context? In context, it means that Nestle has stretched the payable days so long and reduced the days receivable that they do not need to use their own money for their working capital. Now, this generally constitute the working capital, right? Okay. So what it means that in fact, would you like to run a business where you don't need to use your money to buy raw materials, that actually your suppliers will fund your daily operations, right? This is what we want, right? Now, this is one of the reasons why Nestle business is so strong, that they're able to grow in the cash flow, especially their free cash flow, all right? Okay, so these are the qualities that we look at. These are the these are the angles that we look at when we study the quantitative fundamental analysis of a business, other than just looking at the profit growth, other than just looking at the margins of the business, so on and so forth. Yeah. Now, Can we use this, to study other business? Yes, you can, but likely you're not going to find, things like average cash conversion cycles like this, negative. But does that mean that the business is not good? Not necessarily. Okay, Nestle is a very special case because due to the size, they can command, they can control the supply chain very well. And this is kind of results that we look at. Okay, of course, many different businesses are run differently. So we have to look at different angles for different businesses. Okay, so if you imagine if you invested in Nestle in 2003 and hold it and you forgot about this stock since day one and you held it today, right? Your investment will have grown close to 1,400% in the 17 years, which, excluding dividends, all right, just forget about dividends, which compounds about 15% per annum. Wow, 15% per annum, is this huge? Yes, definitely. Imagine if you put the same money in the bank, right? You would have gotten maybe about 3% at best, all right? And Nestle is giving you 15.7% per annum, excluding dividends. Including dividends, all right, you are looking at 1,700% return on investment, right? So again, as I mentioned just now, among the 6 categories of stocks, Nestle is a stalwart as well as slow growth. Not bad for a slow growing company, right? Okay. Now, what does this mean in terms of money, in terms of absolute numbers? If you had back in 2003, talk about myself. I was still in college that time, I think in university. All right. If I had invested 10,000 ringgit on my ang pao in just Nestle alone, right? Today, it is worth more than 170,000, including the dividends. If you invested 100,000 in 2003, it will be more than 1.7 million today. So that is how, how powerful, how sustainable this investment is. Now, then you ask David, yeah, it has grown 16%, almost 16% per annum for the past 17 years. How about going forward, right? Then you got to ask yourself, do you understand the business enough for you to, to decide or to gauge whether this business is going to grow in the future, right? So, I just clicked a few articles, very recent articles for you to see, I think this article was published 2 days ago by The Edge. Nestle Malaysia invests 150 million to set up Asia's first plant-based meal solutions facility in Shah Alam. All right, and what kind of meal that they are producing? They're producing veggie meals, plant-based meat. They're producing almond-based Milo. They are producing, these non-dairy products like almond latte, oat latte, coconut latte. Yeah, these are new products. Some of us may think, I'll never try this, but you never know moving forward, right? When the world, when the consumption behavior of the world changes towards more sustainable food sources, right? This could be the thing that, that will grow eventually. And as a shareholder, as a consumer myself, I believe in this, and that is why I believe that this is a very good candidate for long-term sustainable and Sharia-based investment candidate. Okay, just a case study for you, not a suggestion for you to buy or sell or hold. So I guess that's about what I have to share today. Before I hand it back to Shane, just to recap on what we the gist or the important stuff. Fundamental analysis, in our view, we look at 2 angles: the qualitative as well as the quantitative angles of the business. Not just looking at quantitative, but focus more on quality. Why? Because eventually quality drives the value of the business. The quality of the business, of the management caliber, of the position in the market will drive the performance, will drive the balance sheet, will drive the cash flow of the business. All right. With that, I hope that you have enjoyed my sharing in the past hour. So over back to you, Shane. Thank you very much. Shane, are you around?
Thank you very much, David, for sharing with us how can we do sustainable long-term investing with fundamental analysis.